Investing, especially investing as a beginner, can be very tricky, can be a little complicated, and definitely overwhelming, which is why today I am going to talk about the 10 top mistakes that every beginner investor should avoid. I definitely know the importance of investing, and a lot of people are really getting into investing nowadays. And as a beginner investor myself, I want to share the mistakes that I've experienced in the hopes that whoever is watching this video has as smooth as an investing journey as possible. So my name is Sabrina Rainique, and on this channel we live a life that we love while planning for a life that we want, all through personal finance, travel, and lifestyle. So if you like videos like this, please like, comment, and subscribe, and let's get into the video. So the first mistake that you want to avoid as a beginner investor is waiting too long to invest. As a beginner investor myself, I definitely know the feeling of wanting to know everything you can about investing before you actually invest and risk your money, but waiting for the perfect time to invest when you have the perfect investment plan, or waiting till you have all of that investment knowledge, is just going to keep you from actually just starting. When you just start to invest, you're going to learn so much about it through your hands-on experience. So my suggestion is to jump right into it. I also know that there's so much information when it comes to investing and so many different avenues that you can go for investing, so it can get a little overwhelming and kind of make you hesitant to start. But it's really important to just start with the basics of investing if you are a beginner investor, with videos such as this one and plenty of other resources that are out there to help you as a beginner investor. The reason that I think waiting too long to invest is a big mistake that beginner investors should avoid is because there's a big difference when you invest now versus investing 10 years from now. So for example, let's say you start investing when you're 25 years old and you invest $300 for the next 40 years. If you get a 7% return, which can be typical in the market, by the time you are 65, you're going to have $718,686. Now let's say that for whatever reason you decided not to start investing when you were 25, but instead decided to invest when you're 35, so 10 years later, and you invest that same $300 at a 7% return on your money for the next 30 years. If you allow your money to grow for 30 years as opposed to 40 years, so just that 10-year difference, then you're going to have $340,058.83. So that is a big difference when you really give your money time to grow over a long period of time. So that's why they say the best time to invest was 20 years ago. The next best time to invest is now. And that is because now is the best time to start letting your money grow. So if you are a beginner investor and you aren't sure where to start, you can start investing via your company's 401k plan. You can start investing via automated investing like Betterment or Wealthfront, and you can also look at index funds or exchange traded funds. So if you want to learn more about investments that all beginner investors should know, definitely check out this video. The second mistake that every beginner investor should avoid is trying to time the market. So when an investor is trying to time the market, that means they are monitoring the market and trying to get in when the market is low, meaning that stock prices are low, and selling when those prices have gone up, thereby making them a profit. The problem with that is nobody really knows when the market is at its lowest nor when it's at its highest. As a result, people end up speculating, and speculating is never good when you are a beginner investor. Another thing with timing the market is a lot of times you can spend so much time waiting for the perfect opportunity to get into the market, which will have you waiting for a long time, and you could potentially miss out on some serious gains. So don't try to necessarily wait for the perfect time to get into the market. Just get in and just continually invest, and over a long period of time, your money should grow. The next thing that beginner investors should avoid is trading instead of investing. So trading and investing are two totally different things. Trading involves strategies that focus on profits over the short term, so So whether that's on a daily, monthly, or quarterly basis. And when you are investing, you're taking a more long-term approach to the market. So with investing, you have a more long-term approach, and with trading, you have a more short-term approach. And essentially, you cannot use the same strategies for both trading and investing. Personally, I think that investing is a bit more feasible for the beginner investor because you don't have to worry so much about the volatility of the market because, again, your approach is looking at the growth of your investments over a long period of time. And I'm talking, 5 years, a decade, maybe more. You have done your research and you're confident that through all of the dips, the ups and downs of the market, eventually your investments are going to even out and ultimately grow. And that leads me into my next point. The next thing that beginner investors should avoid is panic selling. How many times do you see in the headlines or on social media and people are saying that the stock market is crashing or this company is going to be doing terribly, and the first thing you think about is your portfolio and how you own that stock and you probably need to sell now. And I think, again, if you are investing for the long term, you do not have to worry so much about the daily, monthly, weekly, whatever fluctuations of the market. You know that your investments are eventually going to bounce back, and through your research you have made sound investment decisions. So when you are investing, relying less on the emotions you may feel when your investments aren't doing so well, and instead relying on the research and the logic that you've put together for your investment plan. Ultimately, don't panic sell if there are fluctuations in the market. Just continue to stick to your long-term investment strategy. So next, I have investing because of FOMO, fear of missing out. So many times I hear people say, I bought this stock because so-and-so said it would be a good investment. And it's like, who is this person? What research have they done on this stock before you spend your hard-earned money on it? And also, why trust this person's advice more than you trust your own research? Unless perhaps if they are a financial expert or professional. But I think a lot of times on social media, for example, you'll see screenshots of people saying, I just made all this money on this investment, and you feel like you are also missing out on that investment or missing out on that money. But it's also important to realize that their investment strategy is not the same as your investment strategy. And not only that, people will always post when they make money in an investment, but they won't post when they lose money. So again, my advice is just to stay the course of your investment strategy and not to risk your money or jump into an investment just because you see someone else is doing it. The next mistake that every beginner investor should avoid is not considering taxes and fees. So because you are making money through your investments, there are taxes associated with your investments every single time you make money. The amount of taxes you owe can really depend on your total amount of income, how long you've owned your investment, and even the amount of income you've earned from that investment. There are fees associated with investing in the stock market, such as brokerage fees, trade commissions, and expense ratios. And these fees can really vary depending on the type of brokerage company you decide to invest with, as well as the type of investment you decide to invest in. So I really suggest being mindful of all of the taxes and the fees while you are investing because they actually can really add up. If you are looking to cut down on taxes, I recommend investing via your retirement account, such as your 401k or your Roth IRA. And if you decide to invest in mutual funds, index funds, or ETFs, I definitely suggest always keeping an eye on your expense ratio. So next, I have investing without doing your research. So many times I hear people say things like, oh yeah, I have an iPhone, so I'm going to invest in Apple. Now, I'm not saying that Apple is or isn't a good investment. However, I am saying that using something or being familiar with a company is not the only criteria you need before you actually invest in that company. You need to determine, is the stock overpriced? Check the news to see if there's anything about this organization that may affect the stock price. You have to look at earning reports. As a beginner investor, I know that that can be a lot of work, and maybe you don't want to be as hands-on when it comes to doing that research for your stocks. So I suggest mutual funds, index funds, ETFs. So the next mistake that every beginner investor should avoid is not having an emergency fund before investing. You should not be investing with money that you need to cover your expenses. There's always a risk when you are investing in the stock market that you actually don't make your money back. So you never want to risk money that you need to live, to eat, to pay your rent. None of that should be going into the stock market. So basically, you want to ensure that even if you lose all of your money in the stock market, and let's say some unfortunate event does happen and you have an emergency, you still do have money to cover that emergency regardless of what your money is doing in the market. You should already have at least 3 to 6 months worth of savings before you even get started investing in the market. So the next mistake that every beginner investor should avoid is not investing at all. Trust me, I understand investing can be overwhelming, it can be confusing, there's a lot of information out there, but investing is becoming more of a necessity. Pensions aren't really a thing anymore, and people are raising their eyebrow at Social Security if it'll even be available for us. So we have to find a way to plan to take care of ourselves when we're in retirement. Even if you're not just investing for retirement, if you're investing for some other goal, it's still much easier and much better if you can make your money work for you instead of you having to save up all the money that you need to reach whatever financial goal you are trying to reach. So again, I know that it can be a really complicated topic, but of course there are resources for beginner investors such as videos like this and all the plethora of videos on YouTube and different articles and whatnot. And then I keep on saying it, but I'm going to keep on saying it. There are mutual funds, index funds, and ETFs for the beginner investor. There's also robo investing where they will make automatic investments on your behalf. So you have some options as a beginner. So the last mistake that you want to avoid as a beginner investor is not investing intentionally. I think that when you are able to invest, a little bit here, a little bit there as a beginner, and you kind of work your way up and become more confident in investing, then that's great. Definitely start off small. But when you are feeling more confident in your investing skills, you want to make sure that you start to put together a plan for how much you need to invest, how long you need to invest, which assets you need to invest in to reach whatever financial goal you're working toward. So you really want to crunch some numbers and do some more research. What are you planning for? Why are you investing? Is it for retirement at 65? Is it for early retirement? Is it for your children's tuition? And once you determine how much money you need to get by a certain date, then you want to start determining how much do you need to put away every period, whether that's every month, in order to get to your investment goal. And there are a lot of great investment calculators on the internet that will show you how much you need to invest, how long you need to invest, and what return you need on your investments in order to reach your goal. So you can play around with those numbers and really put a plan in place so that you can start investing with intention. I like to use the investment calculator on investor.gov for all of my calculations. Like anything in life, anything you want to happen, you have to put a plan in place. So I hope you enjoyed this video. I wanted to share with you the top mistakes that every beginner investor should avoid. If you are an investor, if there are any mistakes that you come across that beginner investors should avoid, definitely put them in the comments below. Thanks so much for watching, and I will see you all next week.